All right, hello and welcome. My name is Jeremy Morris. I'm a tax partner with Williams Keepers in our Jefferson City office. I wanted to discuss with you today an update related to the new tax bill that was passed on Wednesday of this week. A lot of you I had the good fortune of discussing this bill with over the last couple of weeks in our Business Owner Strategy Series seminar on this very topic. At the time, though, what we had was a House version of the bill and a Senate version of the bill, both of which had passed, but at that time we didn't have any final clarity as to what the final compromise bill would look like, or whether a bill would even be passed. So since the bill has been passed, I wanted to spend a few minutes with you today to discuss particularly those items that changed from the versions of the bill that had passed the House and Senate, what's changed in this new version of the bill, and talk about a few planning opportunities associated with that. So the big ticket item on the business, really the crown jewel, the cornerstone of this bill, was on the reduction of the corporate income tax rate. That historically has been at a 35% rate in recent years. It's on a graduated scale up to a maximum rate of 35%. Under the original versions of the bill that had passed, this rate was set to be reduced to 20%, a flat rate. Under the compromise bill, that rate has been increased to 21%, but still a significant reduction from the 35% maximum rate that we previously were living under. In addition to that, the corporate alternative minimum tax has now been completely eliminated under this bill. The Senate bill had allowed for it to stay in its current form. This bill, under the conference bill, the alternative minimum tax at the corporate level anyway has been eliminated. So those are really your big items as it relates to C corporations. As it relates to businesses in general, whether they're C corporations or pass-through entities, one of the big ticket items here is related to fixed asset expensing or depreciation. Right now we're currently living under a regime of 50% bonus depreciation. So for new asset purchases, again not used but new asset purchases, businesses had the ability to write off 50% of that in the year of purchase. Under this bill, we now have 100% expensing for fixed asset purchases. Again, not real property necessarily, but shorter lived assets like equipment. We can write 100% of those off, or 100% of the cost off, for fixed assets purchased and placed in service after September 27th of 2017. So this is one of the provisions of the tax bill that actually will impact 2017 taxpayers. So again, we have 100% expensing. In addition, this has been expanded to also include used assets, whereas it previously hasn't before. So again, both new and used assets would be subject to bonus depreciation. Now, the issue with bonus depreciation, though, is typically it's an all or nothing election. Either you elect it, and all of the assets that are qualified are subject to it, or you don't elect it. So in those situations, it may not be beneficial for a company to take a 100% bonus on all of its assets. We still have this Section 179 expensing. Currently that's set at $500,000, so you can write off the cost of up to $500,000 of fixed asset purchases in any given year. That too has been expanded under this bill to $1 million, and that though doesn't take place until 2018. So again, we have the ability to write off a significant amount of fixed asset purchases in year of purchase, and we even have the ability to do that for assets purchased late in the year in 2017. In addition to that, there were some other items on the business side that we talked about at those seminars related to a reduction or a limitation on the ability to deduct certain items, limitations on certain tax credits. What I would advise you to do is we have a client alert on this on our website that we released yesterday, has some more details on this. Again, at your convenience, we would strongly recommend you take a look at those client alerts to get a little bit more detail related to this. And as always, please don't hesitate to contact your WK advisor to discuss how these particular tax bills may impact your particular situation. So that's the business side. On the individual side, we also saw some significant changes as it relates to tax rates. Again, maybe not the significant rate reductions that we saw on the corporate side, but there is a restructuring of the tax rate brackets for individual taxpayers. One thing that I guess I should mention before we get into the individual side is that the corporate provisions are all permanent. None of those are set to expire. All of these provisions that I'm going to discuss related to individuals are set to expire at the end of 2025. So again, they're not made permanent. We will have an expiration unless Congress in the intervening time takes action to make them permanent. So again, as it relates to individuals, we have a restructuring of tax rate brackets. We still have the same 7 tax rate brackets that we currently have, but the rates have generally gone down, and there's been some adjustment to the income thresholds at which you hit certain tax rate brackets. The tax rates range from a low of 10% all the way up to a maximum individual tax rate of 37%. That is a little bit lower than the current maximum of 39.6%. Capital gains and dividends, the qualified dividends, those will continue to be taxed at the same capital gains tax rates at the same income thresholds. In addition to that, nothing under this bill would impact the net investment income tax, which is at 3.8% Affordable Care Act tax, or the 0.9% surtax on self-employment income. Those are still in play. Those have not been revised based upon this new bill. In addition to the tax rate brackets, one of the other big items is related to itemized deductions. So in addition to adjusting the brackets, this bill also doubles, or almost doubles, the standard deduction for married couples, individuals filing separately, married individuals filing separately. So again, for married individuals filing jointly, that standard deduction has been increased to $24,000, which is again nearly double what it currently is. $18,000 is a standard deduction for heads of household, and then $12,000 for all other individuals. Again, as we'll see, given the fact that Congress has now effectively doubled the standard deduction, we're going to see fewer people being able to take itemized deductions in the future. In addition to that, this bill also sets certain limitations on itemized deductions that we've not previously had, either limiting the amount that you can deduct or the types of items that you can deduct against your taxes. The big one that we've talked about at our Business Owner Strategy series that was a concern, especially to business owners, is on the state and local income tax deduction. Under the previous versions of this bill, there was no longer a deduction for state or local income tax payments, and you could still deduct up to $10,000 of state and local property taxes. The state and local property tax deduction remains, in addition, as well as the $10,000 limit. However, under this new bill, you can deduct $10,000 combined of any combination of state and local property taxes or income taxes. So they haven't completely eliminated the ability to deduct state income taxes, but they've severely limited them, as again you get $10,000 combined in any given year, state and local income or state and local property tax, which again will have an impact on individuals. Individuals that previously itemized and took a significant state income tax deduction won't be able to do so going forward, which will effectively raise their effective tax rate going forward. In addition to that, charitable contributions, those remain. Historically in the past, cash contributions have been limited to 50%. Your deductible amount has been limited to 50% of your adjusted gross income. Any additional amount contributed over that in any given year gets carried over. That limitation is increased to 60%. So again, you have the ability to take charitable deductions as a larger percentage of your income in future years. But again, given some of these other changes, the higher standard deduction, the loss of other itemized deductions, we still may see fewer people taking charitable deductions in future years based upon these other changes. In addition to that, they've also eliminated the overall limitation on itemized deductions. Again, that's something that we've seen for high-income taxpayers in recent years. At certain income levels, your ability to take your itemized deductions began to be limited and phased down. Given the other limitations on itemized deductions, this bill eliminates that phase out of itemized deductions going forward. In addition to that, on the individual side, there's also been a complete elimination of your standard exemptions for yourself and your dependents. They hope to make up for that with an expanded child tax care credit that you'll see going forward. So those are the big items related to income tax rates and itemized deductions. The other big item impacting individuals are those that have flow-through businesses and how those will be taxed going forward. This is something that we discussed in a lot of detail in those Business Owner Strategy Series seminars. It's something that's of interest to a lot of business owners, and it's something that has changed a little bit in this bill, so we'll want to spend a few minutes today to discuss it. As it relates to small businesses, again, if you recall in the House bill, there was originally a rate differential where the income was subject to a different tax rate under the House bill. Under the Senate bill, it's subject to the same income tax rate bracket as individuals, but the income was subject to a deduction. Where the compromise bill fell was in the corner of the Senate bill. So what we're looking at is a deduction against business income under the Senate bill. Under the prior version that was set at 23%, that's been reduced to a 20% reduction or 20% deduction in this bill. So what that means is you have your business income. Generally speaking, you would take a 20% deduction against that and then apply your ordinary income tax rates associated with that income. That only applies to flow-through income from the business, your share of the business profits. That does not apply to wages for S-Corp owners or guaranteed payments for partners in a partnership or LLC's taxes partnerships. That type of compensation income is still subject to to taxation. It's your normal tax rate brackets. Now, there is a little bit of catch. As we discussed, there is a certain amount of complexity that's been added associated with this because it's not just as simple as a 20% deduction. Generally speaking, most businesses or most individuals will get a 20% deduction against their business income, except in situations where those individuals are high-income taxpayers. And that threshold for married filing jointly is $315,000 of taxable income. Once married filing joint individuals, and again it'll be half that for individuals, but once you start going beyond those income thresholds, you then have to look at the level of wages that your business pays. So your deduction's limited to 20% of business income or up to 50% of the wages, your share of the wages that the business pays. And again, that's for high-income taxpayers. Now, if you have a low-wage business but maybe a capital-intensive business with a lot of fixed asset purchases, a lot of equipment, there is an alternative for high-income taxpayers. Instead of looking at the limitation being limited to 50% of your W-2 wages, it can be. So again, the deduction is still there, but it may be somewhat limited for businesses with low W-2 wages or low, capital investments if those businesses are owned by high-income taxpayers or if you are a high-income taxpayer. Now that's for your general business. If you have a service-based business, so in the health care arena, attorneys, accountants, if you're in any of those service type based businesses and you are one of those high income taxpayers and you go over that limitation, there is no phase out in that case. You completely lose the benefit of the 20% deduction regardless of the level of wages you pay, regardless of the amount of capital investment that your company has. So again, to summarize, for S-Corp owners, LLC owners, taxes partnerships, partners and partnerships, and sole proprietors, the Senate bill allows for, generally speaking, a 20% deduction against your income from those businesses, but that will be limited potentially to your amount of wages or capital investment for high-income taxpayers. High-income taxpayers in service businesses lose the 20% benefit completely. So again, we'll see some benefit to business owners, but again, it's difficult to quantify given the lower tax rate brackets, but you add to that the loss of certain itemized deductions, namely the limitation on the state and local income tax deduction, that will increase the effective rate of taxes for some business owners. So again, it'll be difficult to tell, generally speaking, what the impact will be to all businesses. So again, talk to your WK advisor. We can take a look at that in your specific situation and determine what the impact will be to you and your specific business. In addition, finally, so that covers really the main item from an individual income tax standpoint. The other item relates to estate and gift taxes. Again, the estate tax was set to go away under the House bill. That is no longer in this version of the bill. The estate and gift tax remains, but the exemption amount temporarily, similar to the individual components of this bill, it's set to sunset at the end of 2025, but the overall exemption doubles to approximately $11 million on an inflation-adjusted basis going forward. So again, estate and gift tax exemption almost doubles, but only for a temporary period of time. So those are really the main items that have changed in these bills. What we discussed at our Boss Series seminars still holds true. What we're looking at is a world where we're still looking at deferral of income into future years and an acceleration of deductions into the current year, especially on the corporate side, but even for individual taxpayers, we're looking at a 2018 where tax rates will be lower for most individuals. In addition, their business income may be subject to a deduction that it hadn't previously been subject to. So we're looking at lower tax rates going forward. So again, it makes sense to push income into those future years where you may be paying tax on it at a lower rate. In addition to that, accelerating deductions into 2017, where your tax rates will be higher. In addition to that, we have a situation where those deductions may be limited, or your ability to take those deductions may be limited in 2018. Maybe those deductions are limited, or maybe you won't be itemizing at all because of the larger standard deduction. So again, some things to look at before year end. If you have state income tax payments, maybe you're on estimated tax payments. Maybe you know you're going to have a balance due for state income tax purposes. If you're not in alternative minimum tax, give consideration to prepaying those balances before the end of 2017 instead of waiting till January of 2018 to pay them for a fourth quarter estimate, or maybe paying them with your balance due in 2018. Again, because your ability to take those deductions may be limited, give consideration to accelerating those. Same thing with property taxes. If you have the ability to pay property taxes after 2017, consider prepaying those if you can into 2017 and take the deduction now as opposed to waiting until 2018 when that deduction will be limited. Now, one item that we discussed as a planning opportunity in the BOSS series seminar is that we do need to clarify because it has been changed under this new bill. We had also discussed previously opportunities related to prepaying 2018 income taxes. Again, to the extent that we could reasonably estimate 2018 income taxes for states, we had recommended giving consideration to prepaying those in 2017. That was unfortunately under old versions of the bill. Unfortunately, under the new bill, Congress took away our fund related to this, and so now we no longer have the ability to do that. This bill that passed this week explicitly excludes the ability or eliminates the ability to deduct 2018 income taxes in 2017. So again, there's no benefit to prepaying 2018 state income taxes. However, if you have 2018 property taxes and your state or county gives you the ability to prepay those in 2017, please give a consideration to doing that. In addition to that, we're also seeing charitable contribution planning related to this. Again, even though charitable contribution deductions have not gone away, fewer people will be itemizing going forward given some of these other changes. So again, if you're going to be in that situation, give consideration maybe to bunching some contributions into 2017. Again, taking items that you otherwise would have paid in 18, prepay them those charitable contributions in 17, try to take the deduction now when you're at a higher tax rate bracket, and frankly, you may not have the ability to do so going forward. This is particularly true as it relates to donations that come with ticket purchases, as it relates to collegiate athletic events. So again, let's say you make a donation every year to a scholarship fund of a university, and with that comes a right to purchase tickets. Historically, that's been deductible at 80%. Starting in 2018, that will no longer be deductible at all. So again, give consideration to accelerating those deductions into 2017. So that's a lot of information. Again, wanted to hit on the high-level changes from the draft versions that we've discussed previously to the final version of the bill. Again, as I've mentioned, we have versions of client alerts that came out yesterday relating to both businesses and individuals. Take a few moments to look at those. Those will give a little bit more detail than what I provided here. In addition, always, please do not hesitate to contact any of us to discuss how this impacts your particular situation. Again, we're keeping up with this. We look forward to the opportunity to discuss it with you. And again, if I don't see you before the end of the year, happy holidays, Happy New Year to all of you. Thanks.